I want to get to the calls real quick. Let's go to Victoria, Minnesota first and visit with Steve. Hello there, Steve. How you doing?
Hey, Ray. Good to hear you. How you going?
I'm doing well. How about yourself?
Not bad. Boy, I read an interesting article today. I wanted to kind of get your take on it. It's from Yahoo.com. It's an article from Forbes, and it talks about something that Mr. Mark Mobius from Templeton Asset Management has been pointing out in regards to global derivatives. And he said there's something like rumors are, estimates are around 600 trillion in derivatives floating around out there.
That's true.
Which is 10 times the global annual GDP.
Right.
And he made another interesting point, which I'd kind of like to get your take on, in that when the big banks went under in 2007 and 8, they were leveraged about 30 to 1 with these. And he points out that the Fed right now holds like $2.7 trillion on their balance sheet, but only has $52 billion in capital. That gives them a leverage of 51 to 1. He said a 2% move in the decline in those derivatives would wipe out the Fed. And what does a guy do in an investment environment like that?
Well, yeah, but obviously the Fed would print money, and that's why you have hyperinflation and the potential for inflation, and why the gold trade has been so good. No, I think, first of all, Mobius is a pretty smart guy. He's the bald-headed guy that travels around the world, Templeton funds and all that stuff. He's really, really a smart guy and is a pretty darn good money manager. Listen, we've done very little to solve the credit default swap problem. A lot of these derivatives they're talking about are basically insurance bets. There's a bet right now that the U.S. is going to default. And you can make a multi-trillion-dollar bet on that, and a lot of the hedge funds guys have done it. No, I think the point of this article, and I haven't read the whole thing, I just glanced at it 10 seconds ago on your call, but I think the point of the whole article is we still have a lot of the same problems we had before the last financial meltdown, and Congress has done very little to mitigate much of that risk. I mean, there still is the concept of too big to fail. We could not let a big bank fail, and if we did, you'd have the same thing happen all over again. We haven't really solved the credit default swap issue. So if the point is, we're faced with similar situations in the future here and globally, I agree with that.
So, it seems to me that the easiest, it may not necessarily be the easiest, but the most likely thing to happen that you have mentioned would be able to print money to cover the debt, which means, like you say, we're going to have inflation. In that environment, then the kind of things, investments you've been talking about, real estate and equities, are pretty much your only real hedge against that.
No, you're absolutely right. And as I built and have developed and refined my bucket strategy, we've added a couple of other things. If you've read my most recent book, The Buckets of Money Retirement Solution, you'll notice that there is a commitment to guaranteed lifetime income.
Annuities.
A lifetime income annuity. That's based on tons and tons of academic research. And if you use an annuity where you get to control the investments of the underlying sub-accounts, you can dial those up for aggressive growth too, and invest in stuff like gold and real estate, but still have the underlying floor guarantee. Now, you got to pay some fees to do that, but when you do that, a good chunk, maybe 75, 80% of the money is invested in something that has a hedge against inflation, yet at the same time, you have income-producing assets. And, of course, that income from annuities, from stuff like real estate, etc., is what gives you the floor so that you can wade through the next potential financial crisis. And I think a lot of people that had taken that advice over the past few years are quite happy that they did. I had a conversation with someone before the show today who bought one of these lifetime income annuities and was getting a 6% guaranteed withdrawal for the past few years. And they bought it just before the real estate bubble burst and the subprime mortgage bubble burst, and they put $100,000 in. So for the last 5 years, they've taken out $6,000 from this annuity. Now, the annuity is only worth $75,000 today. All right, now, you could say, well, they lost 25%. Well, they really didn't, because they lost 25%, but they made 30 on the yield, right? So they're about even. Call it an even trade. There's a lot of people that would love to be even after we went through that financial crisis, but that's not the good news. The good news is they have $75,000 that is guaranteeing them a $6,000 distribution for the rest of the couple's joint lives. These people are in their mid-60s. They could live another 20, 25 years. That's a 10% distribution. So as dismal as that might look on the surface, when you tear it down a little bit and look at its DNA, all of a sudden it starts to look pretty good. So if you have that in your portfolio and you aggressively invest that money, if the market comes back, you could have a higher income. If it doesn't come back, you're getting basically a 10% distribution or close to it for the rest of your joint lives. That's not a bad deal. It's not a fantastic deal, but compared to what? Compared to buying a home 5 years ago, I think it's a pretty terrific deal. Okay. So this is why you need to have a strategy, because no one can predict the next black swan event. And I think this Forbes article is basically saying we are setting ourselves up for yet another fall, something that possibly could be avoided, but I don't think the governments all around the world have the political will to do it.
How would the inflationary scenario affect your bucket 1 or bucket 2 strategy there?
Well, if you have inflation, then interest rates go up. So bucket 1 and bucket 2 would have better returns, but not enough to mitigate the impact of inflation. Okay. So where you get the hedge on the inflation would be in bucket 3A, real estate, right, and other income-oriented growth vehicles, and then the long-term growth of the stock market and commodities.
All right, Ray, thanks much.
All right, buddy, thank you for the call. Excellent call, excellent point. We've done nothing. What have we done, really, as a country to mitigate the risk of the next collapse? You just saw the guy, what's his name, John Corzine at MF Global, and he levers himself at 40-1. Yeah, we didn't learn that lesson. What lessons have we truly learned? That we don't want the big banks getting big bonuses, but at Fannie and Freddie they can? Come on. Who is kidding who here? We preach from the pulpit about the fat cats on Wall Street, but then the agency that we oversee, that you and I, have taxpayers, have put $180 billion into, Fannie Mae and Freddie Mac, are given, like, on average, $1.1 million bonuses to 12 or 13 people because they have to be competitive. So their salaries of $6 or $8 million are not enough. They got to get a $1.1 million bonus. Give me that job. I'll do it for half that. How's that? I've got a financial background. I should be able to do what these bozos have done. Basically run the whole frickin' country into the dirt. And so we beat up on one sector of the economy, the 1%ers. but we make loans to Solyndra. Oh, that's going on right now. I think that conversation in Congress is going on right now. And again, I'm being critical or political. I'm just saying there's an interesting dichotomy in this country. That's all I'm alluding to. We'll be back. Don't go away.
The Ray Lucia Show.